Good evening and welcome. The Central Bank of Sri Lanka has been established on the 28th day of August in the year 1950. We are gathered here today to celebrate our 66th anniversary. In Sri Lanka, it is a tradition to commence all events of importance with the lighting of the oil lamp. We respectfully invite our chief guest, Mr. Eran Wickramaratne, Honorable Deputy Minister of State Enterprise Development of the Democratic Socialist Republic of Sri Lanka. Our guest speaker, Ms. Arundhati Bhattacharya, Chairman of the State Bank of India. Dr. Indrajit Kumaraswamy, Governor of the Central Bank of Sri Lanka. Dr. P.N. Veerasinghe, Mr. P. Samarasiri, and Mr. S. Lanka Tilaka, Deputy Governors of the Central Bank of Sri Lanka, and Mr. Sunil Mehta, Director of the Board of State Bank of India. Thank you. Ladies and gentlemen, please rise to the national anthem of Sri Lanka.
Mama,
Thank you. We now most respectfully invite Mr. Iran Vikramaratne, Honorable Deputy Minister of State Enterprise Development, to address us at this auspicious occasion.
Governor of the Central Bank, Dr. Indrajit Kumaraswamy, members of the Monetary Board, Mrs. Arundhati Bhattacharya, Chairman of the State Bank of India, Deputy Governors, staff of the bank, distinguished invitees. Let me thank you, first of all, for inviting me to participate in today's event. I also want to use this opportunity to welcome Mrs. Bhattacharya and her delegation for coming to Sri Lanka on the invitation of the Central Bank and on the invitation of the Ministry of Public Enterprises Development to share their experience in financial sector reform. As we know, today's oration is going to be on financial sector reform in India, and I think it's going to be of much value to all of us. So I will not venture to talk about financial sector reform at all, but maybe just leave two thoughts about reform itself. All reforms, including financial reforms, have their underpinning in the value system that prevails. Reforms, when we think about reforms, and professionals like us think of reforms, we think of reforms very much in technical terms, whether it's Basel II or Basel III, or it's some other reform. But the goal of reform is to strengthen the sustainability of whatever that's being done, to increase efficiency, and to strengthen governance. I think all these need to be achieved with reform. But the wider goal of reform is for the common man to have a better life. And that's really the wider goal of everything we undertake. So I would just leave these two thoughts with you. One is, just comes to me in a very practical sense, that people often come up to me and say, now that I have crossed from being a banker to a politician, they come up and often say, Sudusu pudgalayata sudusu thana denna one. But that means is that the most suitable person must be given that particular opportunity. Another way to put it is that the merit principle must be upheld. So the two thoughts I was going to share, this was one of the thoughts. If a country is to progress, we really need to think behind the technicalities of some of the most fundamental and basic values that we either hold or we want to hold. We need to institutionalize this in government. This is not an issue about government being of a particular color, but the issues I raise are much wider. How do we ensure that the most suitable person is appointed to the board of a state-owned enterprise? That's an area in which I have some responsibility. It's not easy in the current context because we have a culture that this principle is not upheld. We cannot depend on the judgment of a person, and therefore we need to have an institutionalized process. But I would also like to ask the question that many of us who talk about this need to reflect on our own institutions. And if we really believe in these principles, we must also practice it. It's not good enough talking about it. Reform, I think, doesn't always come from inside, sometimes it comes from outside. So how do we actually get this done? I can think of two exceptions to the principle of merit, and that is the judiciary and the military. But in my own personal view, I think in every other institution, I think the merit principle must be upheld. The second thought I like to leave with you is a thought while we were talking downstairs over a cup of tea a moment ago. Ms. Bhattacharya mentioned that we must have openness or an open society if we are to progress. And that's my own thinking. Openness as opposed to prejudice. I remember in the early 1980s or so, the central bank had a controversy which was much talked about. And the controversy was that there were graduates from very recognized institutions overseas who were entering the central bank as management trainees. A few years later, I myself joined a bank. And in 1984, I was sent for training to Citibank in Singapore. My former boss, Nihal Valikale, is also here in the audience. And I remember I went to Singapore in 1984, and there was a class of 6 of us. I was from Sri Lanka. They were all others were Singaporean. I was the lowest paid, coming from Sri Lanka. But out of the 6 and the 5 Singaporeans, there was one Singaporean who was not a Citibank employee. He was from the Monetary Authority of Singapore. I inquired, and I found out that the MAS management trainee had a higher entry requirement than Citibank Singapore had. They were getting the best and the brightest into the Central Bank of Singapore. He had a higher pay than the Citibank trainees in Singapore had, so he was also well paid. But he was being sent to Citibank in Singapore for his orientation and training. I reflected on that experience. Societies don't progress in silos, whether they are financial, government, non-governmental, or whether they are the private sector. We learn from each other. We learn by opening the system so we can interact with others with different experiences. We all know that now learning is lifelong. And therefore, there are many benefits in opening the system, including lateral hiring, from government to the private sector, and from the private sector to government. Singapore went one step further. They invited the private sector into the government itself. Personally, I've had the benefit of working in the private sector, serving government in different capacities, heading the National Development Bank, being an opposition MP, and now a part of the executive. Our limitations are our own working. Let's learn from the experience of others, both their successes and their mistakes. So I look forward to hear Mrs. Bhattacharya today and to learn from India's successes and its mistakes. Thank you again for inviting me.
Thank you, Honorable Sir, for that interesting speech. We now most respectfully invite the Governor of the Central Bank, Dr. Indrajit Kumaraswamy, to deliver the welcome address and also present the introduction to our guest speaker, Ms. Arundhati Bhattacharya.
Honorable Minister, members of the Monetary Board, Mrs. Arundhati Bhattacharya and her delegation from the State Bank of India, former deputy governors, members of the senior management of the central bank, distinguished guests, friends and ladies and gentlemen. Now, it's a rare privilege for me to welcome you to the oration to mark the 66th anniversary of the Central Bank of Sri Lanka. And it's a special privilege to welcome our friends from the State Bank of India. Now, I joined the Central Bank when it was 24 years old. And it's a rare honor to be able to come the full circle and to be here with you to mark this very auspicious occasion. Now, the theme of today's oration is financial sector reforms in India. Now, the impetus for financial sector reforms is being generated at several levels. It has several dimensions. Following the global financial crisis, since then there has been a great deal that's been done in the regulatory area, both at the national and international levels. A second sort of impetus, a second source of impetus for this has come from the fact that globalization places a very high premium on competitiveness. And the financial sector is the lifeblood of the economy. As such, it is therefore a critical determinant of the competitiveness of an economy. This places a great deal of onus, great deal of responsibility on financial institutions to improve intermediation, to make it more efficient, so that it contributes to improving the overall competitiveness of the economy. So that's another source of impetus for reform in the financial sector. The third source of impetus comes from technological change. We've seen already in manufacturing the impact of disruptive technology, which has really brought about quite dramatic change. We're beginning to now see it spread to the financial services sector as well. And you know, these pressures, the pressures of rapid technological change, often of a disruptive sort, is not going to spare the financial services sector. And so I think we need to be ready to take advantage of the opportunities as well as to meet the challenges in this respect. So taking all this together, clearly this is a very important and topical theme that we have for the day. And we could not have a better person to talk to us about this than Mrs. Arundhati Bhattacharya. Under her leadership, Global Finance magazine of the US has adjudged the State Bank of India, 1, the best bank in India, 2, the best trade finance provider in India, and 3, the best sub-custodian. Forbes Asia has included her in the elite club of 50 most powerful women in Asia, and the most powerful Indian woman in their list of top 100 powerful business women. She has also been featured in the Fortune list of top 50 globally most powerful women in business, and in the Asia-Pacific region, she's ranked 4th. The Foreign Policy magazine has included her among the top 100 global thinkers. So this is a formidable list of achievements for our speaker today. These and many such honors aptly describe Ms. Arundhati Bhattacharya, Chairperson of the SBI, India's global banking conglomerate. These laurels, however, rest lightly on her shoulders. Having taken over as Chairman of SBI in October 2013, in fact, she is the first female head of the institution in its over 108-year history. She has been grappling with resolving issues to lead and transform SBI into a top-notch global institution. Her actions and policies in this direction have made SBI a force to be reckoned with. She is greatly respected for her frank and open views. In matters of finance and banking, her word carries a great deal of weight with the government of India, the regulators, and her peer bankers. One does not normally associate a banker, and that to a public sector banker, with the term entrepreneur. But she has been named the CEO Entrepreneur of the Year as well by Ernst & Young. Ms. Bhattacharya is also associated with various initiatives for empowering the challenged and differently able, with the aim of integrating them within society. She has clearly smashed the glass ceiling, which tends to be very formidable particularly in the financial services sector. We are indeed privileged to have Ms. Arundhati Bhattacharya to deliver the 66th anniversary oration of the Central Bank of Sri Lanka. Thank you.
Thank you, Governor. Let's welcome Ms. Bhattacharya.
Honorable Minister, Governor, Central Bank of Sri Lanka, Dr. Kumaraswamy, Deputy Governors of the Central Bank of Sri Lanka, other distinguished invitees from the Government of Sri Lanka, invitees from the print and electronic media, ladies and gentlemen. I deem it a great privilege to have been given this opportunity to address a very distinguished and erudite gathering assembled by the Central Bank of Sri Lanka to commemorate the 66th anniversary of this bank. On a lighter vein, I was a bit surprised when I got this invitation. As you know, as a practitioner, whenever you get a letter from a regulator, your anxiety level and your BP goes up a little. And so I was very pleasantly surprised to get instead this invitation, and also very impressed that the central bank thought it important to take the views of a practitioner, probably reflecting that financial supervision now has really come center stage. I have been asked to share my views and experience on financial sector reforms in India, which have completed a long history of 25 years in 2016. I am glad that our journey on financial sector reforms is now indeed the cynosure of all eyes across the world. Of course, the latest biography, Half Lion, of the then Indian Prime Minister, the late Shri P.V. Narasimha Rao, has revived the interest in the politico-economic history of India during those arduous times. Nevertheless, from whichever quarter it comes, this attention is timely. 25 years is a sufficiently long time span to take a holistic and objective view of these efforts. Thus, I must thank the Central Bank of Sri Lanka for choosing this topic for its 66th anniversary oration. Financial sector reforms were a part of the broad-based economic reforms initiated in the wake of a balance of payments crisis confronting India in 1991. The immediate cause of the crisis was the Gulf War, the withdrawal of foreign deposits, and the impending repayment of short-term borrowings by the private sector. The year 1991 has forever been etched in the memory of Indian people for two reasons. First, the magnitude of the crisis itself that required the country to pledge 20 tons of gold to the International Monetary Fund. The State Bank of India, being the main bank of the government, was actually involved in airlifting all of this gold to London. And second, what followed subsequently when a team led by the then Finance Minister, Dr. Manmohan Singh, dismantled the three fortified pillars of the erstwhile socialist model: the all-pervading public sector, size-constrained private sector, and economic isolation within a span of 6 months. The economic reforms had three sub-reforms: the financial sector reforms, the external sector reforms, and the industrial reforms. Considering that all the sub-reforms are subjects in themselves, I will make some compromises in terms of rigor in my speech. I will begin with a brief survey of the politico-economic context that preceded the reforms in 1991, and also summarize what the 25 years of efforts have finally yielded in terms of various economic aggregates. This is important because the matrix of financial stability, and by extension, the success of financial reforms, inter alia depends on macro fundamentals, structural parameters, and institutional quality that emerged from these efforts. Thereafter, I will cover financial sector reforms and the various aspects of reforms in banking, capital markets, and insurance. I will devote some of the time to the use of technology in banking and financial inclusion initiatives, and the role of public sector banks in furthering financial inclusion. As the Honorable Minister mentioned, at the end of the day, reforms are meant for the betterment of one and all. And therefore, I think this particular subject of financial inclusion is very important. I will then turn towards the major lessons that can be drawn from the 25 years of reforms, highlighting as to why reforms may not have yielded the desired results in some areas and needed a course correction. Economic reforms, and for that matter, financial sector reforms, are as much a political choice as economic. Many authors in the past have given due weightage to political economy in their analysis to judge why reforms succeeded or failed. The consequences of not attending to the political constraints are indeed serious. Why is this so? All economic reforms are based on the assumption of a trickle-down effect. As the social scientist Mancur Olson explains, since reforms promise only future advantage, their urgency does not excite the immediate political constituency. In fact, many of the beneficiaries of reforms are yet unborn. Moreover, since 2008, several questions have been raised on the fact that contemporary policies, apart from delivering growth, may have increased inequality, in turn, sometimes jeopardizing durable expansion. In my opinion, and based on my experience in working in the public sector, the political economy is definitely an important factor in the success of reforms in India. Depending upon which political party was in the driver's seat at different points in last 25 years, the pace of reforms may have differed, but every political party has contributed to the process. A large set of macro parameters show that reforms have largely improved the conditions of people from where they were in 1991. To that extent, I believe that India has been lucky in the sense that the political masters have realized that even if the effects or the benefits from the reforms would come in the future, they have still stuck to the path. The per capita income at current prices, which was rupees 5,621 in 1991, has increased 13 folds to rupees 74,380 in 2014. The reforms generated a high growth rate in terms of GDP. From a low of 1.4% in 1992, by the middle of the 25 years period under consideration, that is in 2004, the GDP touched a new high of 8%. In 2004, India posed current account surplus for the first time since 1972. The second half of the reform period also witnessed a high growth period before the lag effect of the global financial crisis, as well as certain domestic developments on policy front decelerated the growth rate to 4.5% in 2013, only to recover to more than 7% presently. Actually, from the banking sector, this acceleration of growth, the subsequent deceleration, has had its own impact. The banking sector today in India does have a very high percentage of non-performing assets. But the acceleration subsequently again that we have seen is enabling us to hope that we will be beyond this problem very shortly. During the entire reform process, household savings contributed substantially to the growth process. The savings rate, which stood at 23% in 1991, improved rapidly to touch a high of 33.7% in 2011. The gross domestic capital formation also improved substantially to touch a high of 36.5% in 2011. Thus, both internal and external adjustments contributed to correcting the balance of payment crisis and reducing chances of its recurrence. Despite easing the norms of foreign direct investment, that is FDI, during this period, it was the household financing of growth which differentiated India's growth story from China, which relied on FDI. The reforms transformed the economy into a self-propagating system that produces itself, consumes itself, and finances itself. While this has been the major difference from the Chinese growth story, however, if you consider the Chinese story, they have definitely had a far more sustainable and higher share of growth, enabling them to draw many more people out of poverty. They have been able to do this because the foreign direct investment that has come into this country the entire system has been made so smooth. The ease of doing business as you come into the country has been increased to such an extent that people who have invested in the country have been enthused to go in and do so. In India, on account of the fact that we do not have a command and control society or an economy, we have had these challenges of ensuring that amount of ease of business. But as a result of that, it is not as though we have stayed static. As I have clearly stated, the parameters have indeed increased, but probably if we had been able to create that openness and that ease of doing business, it would have gone even further up. But in the meanwhile, on account of the self-propagating system that the Indian economy has, it is indeed turned out to be a sustainable and a strong economy. In terms of the distribution of newly acquired prosperity, the reforms process did not create wide disparity as is assumed. If one measures income inequality using the Gini coefficient, then for the period 1996 to 2005, the Gini remained almost unchanged at around 0.36 with marginal decline by 2005. However, the recent 2015-16 economic survey using the methodology proposed by Thomas Piketty concludes that for the period 2000 to 2014, there may indeed have been a growing concentration of income at the top with the top 1%, 0.5%, and 0.1% of the people accounting for 12.4%, 9.4%, and 5% respectively of the income of the entire Indian economy. In essence, the western parts of the country benefited more than the eastern parts, leading to challenges of regional migration towards the west. As a result, under the concept of cooperative federalism, a balanced transfer of resources to states under the recent 14th Finance Commission recommendations for achieving balanced economic growth has been initiated. Nevertheless, inequality has not thankfully led into any major unrest in the population, and the government's redistribution programs are completely focused on achieving an equitable and much needed balance. This is indeed a subject that can be talked on at length. In fact, Minister, we were talking about it at lunch. The distribution of revenues, of the income of a nation to its very many parts, and the way that it should be done in order to bring about an equitable growth is indeed a matter of great concern. In India, if you see, the weaker parts of the nation are also the most populous. So if you redistribute your revenues on the basis of the number of people, the more efficient parts of the country then feel that there is no premium on efficiency, that it is the inefficient that get more money. However, on the other hand, if you do not give the more populous part of the nation more resources, how else will they grow? So therefore, this is again a subject and a matter that is of great importance to the government, and it is the policy makers that have to very carefully deliberate as to how the resources should be devolved amongst the people. The size of the middle class in India has expanded in the last 25 years. Taking into account the population growth rate of 2%, the poverty headcount percentage, though it has declined significantly, still is above 20%. The deregulation process in the organized industry and the reducing role of public sector moderated the pace of employment generation in this sector, with the effect that the informal sector of the economy became the main driver of growth, contributing over 36% of the GDP. This one factor, the informal nature of economic activity, the largest disaggregated business ecosystems in the entire world, sustaining around 500 million lives, would later become the single point agenda of our second generation banking reforms in 2015, the aim being to bridge the informal sector with the formal banking system. This is what I will now turn my attention to. The initial attempt to start some reforms in the financial sector began almost a decade before the 1991 crisis. The Chakravarti Committee, 1982, was constituted to review the working of the monetary system. However, the real thrust came when the Government of India constituted the first Narasimha Committee for Financial Sector Reforms and the Rangarajan Committee for the Balance of Payments in 1991 to ward off the impending crisis. In all, 8 major committees were formed just to review and reform the banking system, capital account convertibility, and monetary policy frameworks, with the latest being the Raghuram Rajan Committee of 2007. Synchronously, the government also constituted the Malhotra Committee in 1994 on insurance sector reforms, followed by the Dave Committee on pension sector reforms in 1998. By 1992, the Controller of Capital was abolished, with government passing the SEBI Act to create the capital markets regulator. On the banking reform side, the RBI's overriding concern was the phenomenal fiscal dominance over the monetary policy, forcing RBI to stipulate higher statutory liquidity ratio of 38.5% and high incremental cash reserve ratio of 15%. So you can imagine the amount of deposits that was getting preempted from the banking system and what the banking system was left with in order to lend. Both CRR and SLR now stand reduced. SLR is being reduced by 0.25% every quarter, so that it will ultimately come down to 20%. It now stands at 21.25%, and CRR is currently at 4%. By 2001, the RBI had migrated to the one-day refinancing window called the repo rate under the multiple indicator approach. The multiple indicator framework has now been replaced with the flexible inflation targeting framework. It is to the credit of the Reserve Bank of India that in the recent April policy, it has synchronized policy strategy and the conduct of liquidity management with the accommodative policy stance. Prior to this, policy strategy and stance were not synchronized, and this resulted in slow transmission across the banking system. In fact, till last March, the liquidity policy was one that was kept in the deficit mode and the highly deficit mode. On the other side, the cuts in rates were occurring. But if you cut rates and if you do not have adequate liquidity, transmission does not take place. That is why from April of this year, the two have been put in synchronous situation, so that the Reserve Bank has now decided that liquidity will also be at a neutral mode so as to enable the transmission of the rate cuts. In particular, under an inflation targeting regime, central banks signal the intent of their policy decisions by committing in advance to an inflation path. For India, they have decided to follow a path of 4% with 2% on either side, adhering to the target either by achieving it or giving credible explanations for any deviation with the commitment to return to the path helps enhance credibility. Credibility, sustained over a period of time, in turn fosters the reputation of the central bank in delivering on its commitments. And once its reputation is entrenched among economic agents, the central bank can necessarily prod market expectations to where it desires it to be, in consonance with the objectives of its policy. This is exactly what RBI has been doing and will do further once the Monetary Policy Committee is formed with the mandate of inflation targeting. The impact on the banking sector as a whole of the reforms initiated was encouraging, with deposits which accounted for 33.8% of the GDP swelling to 94% of the GDP by 2010. The credit to deposit ratio, which stood at 60 in 1991, was 72 in 2010. With reforms, banks were able to open more branches. The reforms gradually enabled dismantling of the administered interest rate regime for both deposits and credit. Banks were free to decide rates depending on their cost of funds and margins. RBI issued specific guidelines on asset liability management in 1999 based on accounting approach and later augmented it in 2006 based on duration matching approach to sensitize the banks of the market risk in the liberalized regime. On the prudential side, RBI has initiated the migration to Basel II by 2005, a process which is almost nearing completion, and banks are gearing up to meet the RBI deadline to complete the transition to Basel III by March 2019. During the last 25 years, many prudential norms, such as those of recognition of income and assets, priority sector lending, foreign remittances, capital adequacy, know your customer, and anti-money laundering have been issued and continuously improved upon. RBI has specially paid attention to the development of the payment system to reduce the cost of transaction. One of the important achievements of the reforms process has been a steady drop in the use of paper instruments, that is checks. Over the years, the entire interbank markets have migrated to what is called the real-time gross settlement system, or the RTGS. On the retail side, customers have the facility to use a similar platform called NEFT for same-day transfers of amounts less than 100,000. From 2010 onwards, RBI is also encouraging banks to use other payment methods like mobile banking, wallets, etc. In fact, the use of these channels have grown multifold in India. We as a public sector bank have a wallet which is now available in 30 local languages. I think the only wallet providing bank in the world to have this. Just last week, we also saw the launch of UPI, which is the Unified Payment Initiative, which is expected to revolutionize the payment landscape by enabling money transfer on the basis of phone number alone. So basically, if you have a caller list in your mobile phone, and if you have downloaded the UPI app, and the person that you want to send the money to also has the UPI app, that is his account number is mapped to his phone number, then merely on the basis of this, you can, with the few clicks, transfer money seamlessly. The banking sector in India, through the reform period, has gradually become more competitive, with the share of top 5 banks in the total market share falling from 46% in 1998 to 39.5% today. Of course, this is not a good thing for big banks like us. But I would like to reassure you that amongst the top 5 banks, our market share has not fallen. And so to that extent, I can confirm to you that the opening up of the banking sector, because of the kind of competition it has given us, has really woken us up from our slumber, so that today we are trying to be much more competitive than even the private sector. By this standard, banking in India is more competitive than in some of the advanced countries like the US. Competition in the banking sector has come from several sources: private banks, conversion of the development financial institution to banks, that is the IDBIs and the ICICIs of the erstwhile India. They have all now become full-fledged banks. New full-scope banks, foreign banks, banks with differentiated licenses such as the payment banks, and technology firms. The recent decision by RBI to grant licenses to 2 private sector banks, a number of payment and small banks, to further the cause of financial inclusion, have been the driving force behind this competition. However, now there are also talks that such level of competition are not in public interest. Therefore, the need for consolidation is especially felt now due to the fact that although India is the 7th largest economy in the world in terms of nominal GDP, there is no Indian bank in the list of the 50 large banks in terms of asset size in the world. We can easily see that large banks reap certain advantages in terms of efficiency, risk diversification, and capacity to finance large projects. The efficiency gains resulting from lower cost of services and higher quality of services are really too attractive to ignore. It is also felt that a large bank may be less risky than a smaller bank, as the larger bank will have a more diversified portfolio, resulting in less volatility in its earnings. Consequently, a large bank may command higher credit rating than a smaller bank. Especially in India, where the public sector space has a huge number of banks, with a lot of banks looking very like each other. So there are clones of each other. But because they are fragmented, they are not really able to carry the kind of heft that they should otherwise have. And therefore, there is, we feel, a crying need for consolidation. An economy functioning on market-based principles cannot deliver growth without a well-functioning capital market. In the last 25 years, the development of capital markets has been mostly undertaken by SEBI, who is the capital market regulator, in equity and corporate debt segments. The RBI has exclusively focused on government securities, including the money markets, call and commercial papers. Among the equity and debt markets, reforms in equity markets have preceded those in government securities. In the mid-1990s, the government first floated the National Stock Exchange and later introduced dematerialization of physical shares to improve the function of equity markets. By 2002, the RBI had migrated the transactions in government securities to electronic anonymous negotiated dealing system, or what is called the NDS-OM. RBI floated the CCIL to settle the trades in government securities through the NDS-OM. The anonymous trading with central counterparty for settlement was the first such model for government securities anywhere in the world and has worked flawlessly since 2008. I think this is one area where India has really pioneered change in the way things are done. And this anonymous settlement with a central counterparty floated by the Reserve Bank of India has been an unqualified success in our country. We have also seen significant growth in the corporate bond market following the R.H. Patil Committee report of 2005, when a number of measures were introduced to develop the market. As of date, efforts are being made to migrate the market in trading platforms like that for government securities. The total corporate bond outstanding has also increased from rupees 7.9 trillion in June 2010 to rupees 20.63 trillion in June 2016, an increase of 2.6 times in a period of 6 years. This is a significant achievement, given that the total scheduled commercial banks outstanding credit was around rupees 72.6 trillion in June 2016. However, our corporate bond market has a very specific weakness, and the weakness is that other than very highly rated bonds, there are no takers in the market. The reason again for this is that the long-term players in India, the insurance funds and the pension and provident fund, the regulators have mandated a particular pattern of investment for such funds. And the mandate as per the regulators is that lower rated bonds will not be taken. As a result, the people with staying power in the market only look for AAA and AA rated bonds. And as a result, the lower rated corporates have actually no takers. This, I think, is a basic difficulty that is there in our market. It's an aberration that needs to be corrected, but it would probably require all of the regulators to get together and take a call and to convince the public whose money they are putting into such bonds that this would be, in the ultimate reckoning, a fair banking risk or a fair investment risk. In continuation of such steps, RBI has last week further revealed a number of measures for developing the fixed income and currency markets. In these, they have implemented a number of recommendations of an earlier working committee, like enhancement of the partial credit enhancement limit to 50% of issue size with bank-wise limit of 20%. As I said, unless this credit enhancement is allowed, the lower rated corporates will not be able to access the market. Enhancement of credit supply for large borrowers through market mechanism, accepting of corporate bonds under the RBI liquidity adjustment facility. Again, a very significant and a material change, because till now it is only, we could only get liquidity from the central bank on the back of government securities. Now they are saying that they will make liquidity available in respect of corporate bonds as well. and the introduction of electronic dealing platform for repo in corporate bonds. In addition, RBI has also allowed foreign portfolio investors to trade directly in the corporate bonds, permitted brokers in repo in corporate bonds, and allowed banks to issue masala bonds for tier 1 and 2 capital and for financing infrastructure and affordable housing. Again, a very material change, because as bankers, all of you know that Basel III is staring us in the face. It is a huge challenge for all banks in the emerging markets. In fact, not only in emerging markets, but even in the developed countries. The capital requirements that are going up under Basel are huge. Now, if we are not able to open up fresh new pools of capital for investing in these bonds, going forward, this would indeed be a great challenge. So the fact that we have now opened up the masala bond route, as you know, masala bonds are rupee bonds that are issued abroad. By opening this up for tier 1 and tier 2 capital of the banks themselves, we have opened up a fresh pool of capital. These steps and their quick implementation dates will, we hope, give a major boost to the corporate bond market in India. Since the reforms, FIIs have been steadily given access to invest in India through the portfolio investment route. The cumulative FII participation since 1999 in equity segment is rupees 8 trillion and rupees 3 trillion in the debt segment. RBI has also initiated the process of developing exchange-listed derivatives for FIIs to hedge their foreign exchange risk in 4 principal currencies of dollar, yen, pound, and the Swiss franc. While the banking reforms have drawn most of the attention, work done in insurance and pension sectors are yet to receive similar attention. Over the last 25 years, both the life and non-life insurance sectors have been steadily opened for foreign participation. The total size of the insurance market is rupees 4 trillion in FY15, with over 50 registered insurance companies divided between 24 life, 23 non-life, 2 specialized, and 1 reinsurance company. The insurance market in India is one of the most competitive. However, despite the supply thrust, the insurance penetration in India is only 3.44% of the GDP in 2015. On the spatial scale, the insurance penetration is mostly concentrated in the western parts of the country with hardly any rural presence. Here again is another area where substantial amount of work is still left to be done. The pension reforms, on a similar note, have progressed relatively slowly since the first report on pension reforms came in 1998. The youngest of the regulators, the PFRDA, was statutorily incorporated in 2013 and currently manages the pension contribution for civil servants and banks under the Defined Contribution National Pension Scheme. The total corpus under management is approximately rupees 1.4 trillion. In a country like India that does not have a social security net, it is actually imperative for us to work much harder on the national pension scheme. In India, only around 11 to 13% of people work in the organized sector, and these are the only people who have access to pension. So if you consider the rest of the population, they are not having any access to anything that gives them security in old age. And therefore, the need to have these products is being felt more and more. The current government is very focused on this, and it is indeed using the banking sector in order to ultimately take these products to the doorstep of the rest of the population. And I will quickly talk about it when I talk about financial inclusion. Having surveyed the broad contours of the reform process, I will now turn my gaze on how the reforms have fared and what lessons can be drawn. This is not an easy reverse gazing because there are many yardsticks that can be chosen. If macro stability is the chosen criteria, then financial sector reforms have performed well. There are no major economic crises in the last 25 years whose origins can be traced to the domestic financial system. Nevertheless, financial markets have failed to impress the retail investor, and I think therein lies our biggest failure. The retail participation in both equity and debt has not been as per expectation, and bank deposits still constitute the preferred choice for savings. This, I believe, is an area that still needs a lot of work and attention for it to achieve the desired results. In fact, only during the last week, I was on the same platform with the governor, and we were talking about this, and I was telling the governor that I can bet you that all the ex-governors of Reserve Bank also have all of their savings in bank deposits. So if that be the case, you can understand that the general public, where they are, and why we need so much more of these reforms to ensure that they get a proper return by investing in other areas. But if we are to evaluate the financial sector in the reform period in its ability to respond to the demand of the non-finance sector of the economy, we may reach a different conclusion. Financial reforms inadvertently did create incentives that encouraged informal finance systems, which necessitated a course correction in the form of financial inclusion. An RBI study by Narayan Pradhan using All India Debt and Investment Survey data commented on this phenomena and observed that in rural India, the combined share of all the non-institutional credit agencies in the outstanding cash dues to cultivator households recorded a sharp decline of 32 percentage points during the 1970s, but the decline got arrested in the 1980s. Thus, a course correction was warranted because high levels of financial exclusion may have impeded the monetary transmission mechanism, increased cash intensity of the economy, as well as ultimately led to social unrest. Following the recommendations of the Raghuram Rajan Committee report of 2007, the RBI, in collaboration with the Ministry of Finance, adopted a bank-led model for financial inclusion, which sought leverage on technology. The initiatives would have to be information communication technology based and would ride on new delivery models, namely the no-frill account banking, franchisee banking through the business correspondent model, using mobiles as conduit for financial transactions, micro-lending, etc. The 4 pillars of this policy include the credit flow to priority sectors, financial education, credit flow to MSME, and institution building. Actually, this is one area that really and truly, I think, has been one of the major successes of India in recent times. The financial inclusion, which reached its zenith on 28 August 2014, when the Prime Minister launched a nationwide new program titled Pradhan Mantri Jan Dhan Yojana, the PMJDY. This ambitious program targeted the poor who didn't have access to financial services with an objective that provides for easy access to the banking system and the freedom from scam artists and money lenders, and can materially lift India's economic prosperity. So far, that is till the 10th of August 2016, that is about 2 years from when the program was launched, banks have opened 236 million accounts, mobilizing rupees 417 billion rupees of deposits. It is indeed, in fact, we have entered the Guinness Book of World Records for the pace of execution. And what I am very proud of is that it is the public sector banks that have played a major part in this. Actually, financial inclusion has been talked about for a very, very long period of time. What was the difference and how did we do it this time? I think 2 or 3 things were done very differently. First of all, we had a technological enabler. And the technological enabler was that all of banking would be given to the people. People would be able to access them through not necessarily bank branches, but through a franchisee model called the business correspondent. The business correspondent is a mobile model. He doesn't need to be in one place. He can access the bank accounts through a handheld POS, which could be in the form of a mobile as well. A small scanner that scans your fingerprint, and a little printer that gives you a printed receipt. Now, what enabled this was the fact that the Indian government had launched on what is called the unique identification number. This unique identification number in India is called the Aadhaar number. What it does is it captures the 10 fingerprints and the retina scan and then gives you a number. There are very strong deduplication programs that run on the back of this entire application so that one person can have only one number. He cannot have a second number. And the best thing is, because this is a database run by the government, if any person, including myself, if we go and type in our Aadhaar number and scan any one finger, in 30 seconds, the entire data regarding me, including my picture, will be downloaded to your database. Now, this is something that enabled us to do KYC very quickly. We were just discussing that many of the foreign banks now take 5 to 6 days in order to complete their KYC and open an account. We in our bank, in State Bank of India, we open anything between 60 to 80,000 accounts per day with what we call eKYC, which has now been empowered by the Reserve Bank of India. Actually, these two twin things, the mobile and the Aadhaar database, these are the two things that enabled us to do this financial inclusion very rapidly. Also, what was done this time, as is different from what was done earlier, every single part of the country was subdivided into what were called SSAs, sub-service areas. And the banks were asked to do a survey to see which of the households didn't have bank accounts. We were also told unofficially that please try to see that if there is a household that doesn't have an account and you're opening an account, try to see that the woman of the household has that account. And actually 55% of women are the account holders. Second, when you are having these account opening camps, there was alongside what is called an FLC, a financial literacy camp. So basically, we were telling the people who were opening the accounts what an account means. How does it help? Why should you have it? And because we also had the franchisee model, which enabled us to give these business correspondents the ability to become what were virtual bank branches, we increased the access of the population. Just to tell a small story, I have a lady who comes and does my hair at home. And obviously, she is not from the upper reaches of society. Now, she has a very difficult situation in the house. Whatever money she takes or she makes, the moment she goes to the house, it is taken out of her hands. But what she does these days, she tells me, is on the way back home, she deposits much of it with one business correspondent who's also a shop. So the grocery shop fellow has also taken a business correspondent license, and he's acting as a business correspondent. On the way home, she's able to deposit much of her money. She takes home 100, 200 rupees, because in any case, she has to give money when she gets home. But much of her money is now getting saved. Now, this is the kind of change that has happened, with access having become much more easy. No longer do you have to queue up in the bank branches and waste half a day's labor, which people don't want to do. You can actually start accessing your bank account through these business correspondents. Not only do the business correspondent make sense in that they allow these people to access bank accounts, but these business correspondents have also created employment. For instance, we in our bank alone, we have 56,000 business correspondents. 56,000 jobs, but now the business correspondents, wherever they have more transactions, they are in turn employing 2 to 3 people. And all of these people get paid on the basis of the number of transactions. So the more they do, the better well paid they are. And therefore, it is a totally incentive-driven model. Here again, technology was very important, because earlier we used to have these small deposit collectors. And many a times these deposit collectors would take the money and disappear. Today, because of technology, we can actually monitor the business correspondence transactions on a daily basis. And the instructions are 10% either way. Then the hub branch, each branch is a hub which has several business correspondents linked to it. It can be anything between 14 to 40. If there is more than a 10% variation on either side, the hub branch is required to visit the business correspondent and find out what is wrong. So that even if there is any problem, even if the fellow has run away, you can minimize the impact to the extent possible. So I think, these were the very many types of innovations that the banking sector, the regulator, and the government did in order to bring about this financial inclusion. The good part is, now that we have created these business correspondents, and they need, as you can understand, more and more business, otherwise they will go off. They will go off into some other activity. And therefore, that is where now the pension sector and the insurance sector and the mutual funds, they have all come in with very, very simple products so that we can sell it to these people. Again, for these people, it becomes very important. Today, for instance, for 12 rupees, you can get insurance, accident insurance, for 2 lakhs of rupees. 12 rupees only. You can get 2 lakh rupees of insurance in case you have total disability or death by accident. These are the kinds of small value products that we are now ramping up through the business correspondence in order to bring about, as I had told you earlier, the kind of social security net that we are lacking. Similarly, with insurance products, on insurance, if you pay 340 rupees per year, you are eligible to 1,000 rupees of pension from the age of 60 onwards. So all of these products that we were lacking and where the penetration was so low, with this franchisee model, the franchisee model, as I said, it's almost a private model run by the public sector, but it's a kind of a meeting of minds of both. But this has actually enabled us to create the kind of financial inclusion that we have been talking about, but which we have not been able to get to. And therefore, what we believe is we have now created a trinity which we call the JAM trinity. J stands for the Jan Dhan account, A stands for the biometric, the Aadhaar, and M stands for the mobile. So with this JAM trinity, actually what has been always the dream of our people, that we should be able to deliver the financial services at their doorsteps, that is almost coming true. Further, in this year, the Union Budget announced the formation of what was called the Mudra Bank. The Mudra Bank is responsible for developing and refinancing all the micro-enterprises sector by supporting the financial institutions which are in the business of lending to micro and small business entities engaged in manufacturing, trading, and service activities. Mudra would partner with banks, MFIs, and other lending institutions at state level, regional level, to provide microfinance support to the micro-enterprise sector in the country. As against a target of rupees 1.2 trillion, the banks and MFIs together have disbursed rupees 1.3 trillion, thereby achieving 109% of the target. The achievement by public sector banks indicate a substantial credit growth in this segment. Based on the data collected from the PSBs, it was seen that the disbursement by these banks in this segment was around rupees 330 billion during 2014-15, which has recorded a growth of 70% during 2015-16. Now here again, there is a small difference that we have made. Earlier, as you know, in India, we would have what were called the loan melas. So you would call all the people in a particular locality and give them small value loans. Normally, 70 to 85% of these loans became bad. What we realized is giving of loans is not enough. You need to have the capacity to absorb the loans and make sustainable businesses. And therefore today, most of the banks in India run what are called the RCTs, the Rural Training Institutions. We as a bank run 117 of these. And what we do is in these rural training institutions, we actually give training in vocational areas. So it could be for becoming a carpenter, becoming a plumber, becoming an electrician. We also try to tie up with industry. If a construction major like L&T has the requirement of people for, say, plumbing or for, say, electrical work, then we will prepare batches of electricians and send it on to them. Not only that, we try to find the scope of businesses in the local community. For instance, just the other day, we filmed one such success story of a fellow who has been trained in order to make grills. You know, the iron grills that are required for every door and every gate. And this chap has been trained in welding and in designing of these grills. And today, he not only has a business, he employs 8 more people. So the fact of the matter is that while we are trying to give these loans, we are trying to first see whether we have trained these people and they have the capacity to absorb the loans. And that is the difference between the loan melas of the earlier years and the Mudra loans that we are now trying to give. And as a result of this, I believe as we create more and more capacity for absorption of credit, we are creating a virtuous cycle whereby we are taking the unorganized sector a step further in providing to them the initial amount of money they need, but not only money, but the initial amount of skills as well, without which giving of the money is actually of no use. Financial inclusion and infrastructure development are mutually reinforcing and can provide impetus to economic growth. Banks have played a pivotal role in providing finance to infrastructure and supporting economic growth, particularly after the phasing out of development financial institutions. The outstanding bank credit to the infrastructure sector, which stood at rupees 95 billion in March 2001, has increased to rupees 10,074 billion in March 2015, a compounded annual growth rate of 39.5% over the last 14 years. The age-old argument against bank financing of infrastructure has been the issue of asset-liability mismatches. Typical funding sources of Indian banks are deposits, which are short-term financing for long-term assets, such as infrastructure, and this leads to ALM mismatches. This has indeed led to difficulties post-2012. In fact, the NPA burden that I was talking to you about is mainly caused by this, that we have funded 30-year assets with 7-year money. Lack of acceptability for takeout financing amongst insurance and pension players have also prevented banks from offloading infrastructure exposure and taking on new exposures. After the 2008 crisis, supply of adequate promoters' equity has also deterred banks from lending to infrastructure. This again is a perennial problem of all emerging nations, that promoters actually do not have adequate equity, and therefore we need to find pools of equity outside of the country. The Government of India has floated a National Infrastructure Investment Fund to address the issue of equity to some extent. Nevertheless, notwithstanding such issues, banks are expected to continue to finance long-term projects for a considerable period. RBI has therefore empowered the banks to raise longer-term resources through infra bonds, as also mandated a maximum exposure of 50% from the banking sector in larger projects. Another area where financial reforms process was slow to react to the needs of the economy was in the area of law. That the economic reform process will have a significant impact on Indian financial law was recognized way back in 1992. As financial institutions increased discretionary lending, the legal framework for defining and protecting the rights of creditors and debtors became critical. However, the process of changing the relevant laws has taken a long time, and it is only in 2016, that is this year, that major laws such as the Appellate and Commercial Division of the High Court, the bankruptcy laws, amendments to the SARFAESI and DRT, these are basically laws for enabling us to recover the assets, and customer protection have been legislated. In fact, this is one area where India, I think, has been very, very slow. And again, one of the areas why we have not seen the growth in the bond markets. If you are going to give money and you do not have a quick and efficient and transparent system of recovering that money, people will be extremely wary about lending there. In fact, the strange thing about India today is that you have two parties who are both Indians doing a project in India, but when it comes to an arbitration, the parties are going to Singapore. The entire arbitration is done in Singapore by parties who are Indians, by lawyers who are Indians. Everything is in India, excepting that the arbitration is happening in Singapore. Now, these are the sort of anomalies that we really need to take care of, because unless and until you have a very just system of ensuring that any problems that come up get resolved to the extent possible, as quickly as possible, the depth in the financial markets will be lacking. I will now conclude my address on financial sector reforms in India. It is my submission that financial reforms have significantly benefited the general population by making available a range of financial services at affordable prices. Financial sector has been a major employment generator in the formal sector. The financial sector was not really able to respond to the demands of the non-financial sector in the second half of the 25-year period under consideration, but has been receptive to the use of technology and has increased the reach to unbanked areas. I also feel that the reform process has failed to attract retail investors to the financial markets, thus increasing the risk of excess financial intermediation through the banking channel. Also, financial sector reforms have been very gradual and not big bang. Perhaps this has vexed many foreign participants who wished for a much faster pace. However, with strong political stability, it is my expectation that the pace of reforms will pick up, though the element of caution will stay. Within the financial sector, the contours of banking in the coming decade will move in two directions. One, services will be more integrated with technology. Second, their reach and span will increase many folds. Banks will nevertheless retain their basic brick-and-mortar structure, though traditional banking will be catering more to specialized services rather than general services, which will move to the self-service mode. We are already seeing this in India. The youth in India no longer want to be anywhere near the bank branches. They wouldn't be caught dead in them. They do everything from the comfort of their rooms, and everything can be done from the comfort of their house. However, whenever it comes to specialized activities such as wealth management, housing, investment, you still need the brick and mortar structure, because while the youth are quite comfortable with talking to you on a screen, we still have a vast majority of the people who will not believe that their money is safe unless there is a touch and feel about it and they can see a brick and mortar structure. Within the banking industry in India over the next decade is well positioned to capitalize on the vast potential of its demographic dividend in India. Not only can banks reap the benefits of cheap and IT-savvy human resources, but they will also benefit from the latent demand of financial services of this young cohort. India today is 1.3 billion people strong, median age of 26 and a half. So we have a huge young population with all of their aspirations and all of their entire life cycle still to be completed. And that gives you enormous potential for banking services. Going forward, the financial sector reforms will be more closely aligned to the real sector. Unlike the experience of the last 25 years, their success will depend on policy execution in other sectors. For instance, mobile banking will succeed in India provided the telecom policy ensures seamless broadband connectivity across the entire country. Bank-led financing of infrastructure will be sustainable if capital markets master the confidence of retail investors and pension funds to positively look at takeout financing and exposure, if necessary, to junk bonds as newer options to invest. I hope my address has informed the audience of the complexities of the financial sector reforms, on the challenges of their sequencing, and in the unintended outcomes that may emerge, and that our experience of the reform process can provide some pointers that would be useful to you in your journey. Thank you so much.
We now most respectfully invite Governor of the Central Bank, Dr. Indrajit Kumaraswamy, to present the token of appreciation to Ms. Arundhati Bhattacharya. Thank you. To deliver the vote of thanks, we respectfully invite Mr. P. Samarasiri, Deputy Governor of the Central Bank of Sri Lanka.
Honorable Deputy Minister, Honorable Governor, Mrs. Bhattacharya, official of the State Bank of India, ladies and gentlemen. Deputy Minister, we know your keen interest in promotion of financial sector in all aspects, business models, risk management, governance, and transparency. And your keen interests are placed on well record. Deputy Minister, therefore, your attendance at this forum is highly encouraging, and despite your busy schedule, we thank you for being present at this forum. The Governor thanking is a pleasant job. So it helps attract people to like you. Unlike in our office environment, therefore, I thank the governor for giving me this pleasant job, as well as delivering the welcome address to place the platform for the session and making the introduction of the guest speaker. Ms. Bhattacharya, I think we all agree we have had the great opportunity of having Ms. Bhattacharya today to mark this 66th anniversary of the central bank, which is still young central bank compared to the leading central bank in the world. Ms. Bhattacharya, your globally high-ranked professional profile while running the post of the chairperson of a giant, complex Indian bank like State Bank of India. Your profile is well demonstrated by your address you made to this distinguished audience today. Financial sector reform is never-ending task and talk among the central bankers and the policymakers world over. In this perspective, your address today not only shed lights on insight into financial sector reforms in India, but also could open eyes of central bankers to different dimensions to financial reforms, not only areas and results, but also flavors of different challenges. Ms. Bhattacharya was talking about the Indian banking business models. I had rare opportunity to see her interview at the Bloomberg one time, and she said her bank in her business model is trying to maintain the systems to cater to all three generations under one roof: the young, middle age, and old age. I think that is what she was trying to explain you at the last. While looking forward to listening to you tomorrow's event at the Central Bank, I take this opportunity to thank you for highly resourceful address made to this audience today. Ladies and gentlemen, this event could not have been possible without your presence here at this time. Despite your evening plans, you devoted your valuable time for the central bank by attending this function. Thank you for your time spent for the central bank and the enhancement of your knowledge on this subject. Finally, I thank all those who work hard for making this event a success. Thank you all again, and enjoy your pleasant evening and have a good night. Thank you.
Thank you, sir. We have now come to the end of the event. We warmly invite all of you to join us for tea, which is served in the lobby. Thank you for your presence and have a great evening.